Welcome to the BTC Markets Koinly crypto tax webinar. We got a lot to cover today, lots of information about crypto tax, and it's great to have Caroline with us, the CEO of BTC Markets. Welcome.
Thanks so much for having me. This is my first podcast in a studio. It's very exciting.
Excellent. And so, Caroline, tell us a little bit about just a quick intro about BTC Markets.
Yeah, brilliant. So we've been around since 2013, based here in Melbourne, though not in the lovely surroundings of Brunswick. And we have purely Australians on our platform. So we've got about 325,000 Australians who've traded about $24 billion since we started 10 years ago. And I think that makes us a bit of an OG in crypto, the fact that we've managed to be around for so long. But as I say, yeah, we purely trade for Australian clients, and we've got a limited number of pairs. I think we've got about 25 trading pairs. That's a number that's increasing on the day. But our focus has been primarily on kind of the blockchain economy and growing the blockchain economy and making it accessible in a safe and kind of transparent and easy way for Australians to get involved. So thank you so much for having us. This is really fun.
Not at all. Thanks for being here. And I suppose, a hot topic is regulation and compliance in the crypto space. And, we're really seeing a lot of noise around this, a lot of news, particularly with exchanges. And, of course, tax is just one area of regulation, and we'll get into the details a bit later. I've got a bit of a presentation on that. But, I suppose from your perspective as well, how important is tax, and are your customers really asking, for help around tax reporting, and what are the attitudes towards it?
Yeah, absolutely. And I think that their attitudes towards it kind of mirror my own around taxation and in Australia in general. I'm absolutely clueless. I absolutely need experts to guide me through it. And every year, as we move into June and then July, the requests start coming through of we need help with our tax. And we can only do so much because we're not tax experts by any stretch of the imagination. But there is, I think, an understanding that two things are sure in life: death and taxes. And I think that Australians are very willing to participate with the ATO. But I think, as I say, they do need help with that, and we're happy to kind of work with you guys and provide some of that assistance.
Yeah, excellent. And it's I suppose in some ways a shared kind of interest to help people comply and stay on the right side of the rules and do the right thing. And when it comes to tax, the taxpayer is solely responsible for their tax returns. You can use an accountant, but at the end of the day, it's your name on the tax return, and so something to take very seriously, nonetheless. So let's get into a little bit on the tax stuff. So for anyone that doesn't know, I'm Danny from Koinly, head of tax here. We've been around since 2018. So, I suppose not as OG as BTC Markets, but, had a chance to really build out a solid tax platform that doesn't just deal with Australia, actually deals with multiple countries and tweaks all the different tax rules and builds that into Koinly. So, most people listening today will be Australian tax resident. Some people might be dual tax resident. So if you are, then, you can use Koinly for that other jurisdiction that you might be a tax resident in as well. And so a lot of people that use Koinly are really, they don't know much about tax. They want to understand, how can I comply with what the ATO rules are and do the right thing, but do it in a way that's actually manageable so that the compliance obligation doesn't become a huge burden at tax time. And so really what Koinly is about is having a product that automates your tax reporting by linking into exchanges. If your exchange feeds out a CSV or an Excel type file, you can upload that into Koinly. You can also API connect directly to exchanges with Koinly. So essentially what that means is we talk to exchanges, draw down the information off your transaction history, purchases, etc., get all the market values, and then work through what your tax bill might be at the end of the year. And you can send that to your accountant.
Can I ask, as somebody who doesn't know anything about tax, can I ask a question? Can I ask, what's your view, for somebody like me who hasn't got a clue, what's your view about navigating crypto tax in particular in Australia? Like, is it as complicated as we all think it is, or what's your view?
Yeah, so I think for the basics, so for people that do the basics, they let's say they spot trade, the rules are clear in my view, in the sense that you generally know when you have a taxable event or a disposal. If you're an individual and you invest in crypto as an asset class that, you hold crypto like you hold shares or other types of investment, you'll be taxed on capital account. So capital gains tax will apply. You generally won't be a business. And so in those cases, we know the ATO have put guidance out on, when you sell crypto, it's taxable event. And, exactly when do you recognize that? It's the point at which you actually make the sale, transfer to AUD, transfer crypto to crypto. The main thing is actually recording all your market values and all your kind of, you need essentially a record of when you first bought your crypto assets and when you then go and sell it. And we'll run through all of this. But so I think in the grand scheme of things, if you're doing the basics, it's easy. If you're engaged in DeFi, NFT trading, you're creating NFT projects, you're mining crypto, you're staking a lot of crypto, and you might be kind of auto compounding those staking rewards, you're wrapping and bridging. That's when you start to run in a little bit of trouble with the guidance being limited and you really seeking more from the ATO's guidance to comply. And that's where we're finding a lot of the gray area and questions come up in this space around. So
I think too that, just shows how far we've gone. As you're talking about it, I'm thinking, God, yeah, how far the industry itself has in the last few years in terms of the things that we're talking about. But may I just ask, I remember when the controversy used to be about when you would convert your Bitcoin to Ethereum to then engage in DeFi, and the fact that conversion from Bitcoin to Ethereum could become a taxable event. And that was the single biggest controversy that we had to deal with. Right. Now, when you're talking about wrapping and compounded staking gains, like this is getting complicated.
And even when you transferring Bitcoin into ETH, there's a lot going on for tax purposes. So it's not, yes, you can do it at the click of a button on an exchange, but really what you have to do from a tax perspective is know, okay, well, what price did you buy your Bitcoin at? When did you buy it? You sell it. Okay, when did I sell it? What's the market value of the Bitcoin when I sold it? So you've disposed it. And then you've bought a new asset. So you again have to work through what your purchase price was for your cost base to then work out your gains. And that's not even considering things like gas fees or transaction fees that you might incur on exchanges.
Oh my gosh.
So yeah, it's a simple transaction. There's still a lot going on, but that falls more on the record keeping side.
Yeah, sorry, now I've hijacked you enough. Carry on.
Not at all. So let's just do a quick disclaimer. Obviously, Koinly and BTC Markets are not financial or tax advisors. So this is purely just for educational purposes. Don't listen to us. Please do speak to an accountant. So I've got some slides here that we'll talk to a little bit, and I'll throw it to Caroline a little bit during these as well. And I just want to say, if there are questions, please put them through on the chat, and we'll try and get to them. Absolutely. If we don't, we can try and get to them afterwards. And there's also a Koinly discount code, which I'll read out at the end. So, this slide, crypto assets take different forms. So when you're thinking about tax and crypto, what types of crypto assets are actually taxable? Well, really the answer is all of them. And this slide's just showing, how many different types of crypto assets we have, traditional cryptocurrencies like Bitcoin or stable coins, asset-backed tokens, game tokens, NFTs. So, people thinking, oh, I'm trading NFTs. It's not really, a coin. It's taxable. It's taxable just like Bitcoin is. Now, whether it should be or not is another question. And sure, people have different use cases for these assets as well, which, obviously does lead to questions on what the right tax treatment is. So, for example, if I purchase a cryptocurrency for, just to then later spend on a concert ticket or so on, I might be buying it as a currency. But we know most people are using it as an investment. And, keen to hear your thoughts on how people are using crypto they're holding on BTC Markets as well. Yeah,
that's a good question. And again, kind of goes back to those early discussions around the intrinsic variable nature of Bitcoin and its use cases. And that's before you even spin off into Ethereum, because Ethereum being far more considered as a utility token than a currency, in my view. And I think that's kind of a view that's shared. What we're seeing with people, yeah, absolutely. You see people who are looking at Bitcoin in particular as an investment. Then we saw the explosion in DeFi. Then we saw the explosion in NFTs. And that's created, in my mind anyway, this greater blockchain economy. And so when we talk about these disposals and the usage of it, I kind of think about, well, when I'm spending my Australian dollar to buy a piece of art in a gallery, the taxable event that's created there versus the what could happen if I'm buying an NFT and the unending kind of amount of tax that seems to follow this one transaction around, which from somebody who's a layperson, I find that quite challenging to get my head around. But I do think that's certainly what we saw the spark, and certainly we saw that spark in the Ethereum price point. That once the DeFi and the NFT in particular gathered steam over the last 2 years in particular, the use case has gone beyond just buy and hold or pure speculation. There's all these other utilities.
That's a great point, and that actually does lead me on to kind of talking about regulatory pressures as well on exchanges, not just exchanges, but users to comply with tax guidance and so on. So we know in Australia there's a token mapping exercise that's happening at the moment. Essentially, Treasury are categorizing tokens to work out which bucket of regulatory kind of fields they should apply, essentially. And so that process is ongoing. And from a tax angle, what does that mean? I think what we need is some level of indexation or categorization of what is crypto from a how are people using it to then work through the tax treatment. And it's not as simple as saying Bitcoin is an investment token, because we don't know what people may use crypto assets for in the future, and there'll be different use cases for a lot of different types of crypto. But there needs to be recognition that one person's tax treatment perhaps for using a particular coin or token isn't the same as someone else. And so there is more work to kind of understand what the flow on is from that. And so I think the tax world are still looking to the token mapping papers and the regulatory frameworks that come out of that to really flow into the tax system as well.
I think too, what was, from my point of view, when I came into BTC Markets about 3.5 years ago, and I've been in finance and been in blockchain and crypto and stuff for a number of years. But what was so interesting was the speed at which the ATO had guidance out. The taxman was there first in terms of regulatory point of view. I think AML KYC came skidding in very quickly afterwards. But we're still waiting for this regulatory framework to come through. And almost like when you look at regulation by enforcement, as we're seeing in other jurisdictions that will be nameless, and you kind of look at it and go, there's almost been like regulation through the ATO in some senses, because of how they quite naturally have had to go in and go, okay, well, what are we going to do? How are we going to treat this product or this asset class? How are we going to tax it? So I think in the absence of a confirmed framework, lots of gaps have just been kind of filled in with guesswork and kind of, common sense in some respects and maybe not so common in the other. And I think that the key point with all of this is the youth of crypto. It's so young. And exactly what you're saying, Bitcoin today may be used for X purpose, but that is a ever-changing dynamic. And that's just Bitcoin, let alone the other, there's 25,000 cryptos out there, but let's put it down to the handful of maybe 25, 30 of them, the variable nature of those. It's astonishing what's going to come. And when you start talking about regulation, I'm such a regulation nerd because I have to be in this job. And one of the things I liked in the early readings of the European regulation that they've brought out, just come into law this year for enaction in the next couple of years, they talked about leaving room in their regulation for innovation, leaving room for change. They were like, we know we don't have the answers. We know we don't know what this is going to look like in a couple of years' time. So we're not going to assume that we do. But this is the kind of best practices that we want to, or the behaviors that we want to encourage. And I think that's true across the whole spectrum of regulation. You want to look at the risk and you want to look at the behaviors you want to encourage. And that's as much true in taxation as it is in market enforcement. So, we've worked very closely with the regulators here and we continue to do so. And I think that there's the sense of like, okay, we've got the token mapping exercise, and the hope is that over the course of this government, we'll see something more concrete that we can all hang our hats on in this industry. Something proportionate and appropriate is my phrase.
I think what's interesting as well on that just broader regulation front is seeing different jurisdictions tackle regulation in different ways. We've obviously got the SEC over in the US that are addressing matters with certain individual companies prior to releasing broader frameworks and guidance. And so I think perhaps in Australia we're seeing a slightly opposite approach, which is probably good, but we want to see regulation come in sooner so that people do get that clarity, businesses understand the frameworks they're offering.
Here's the thing as well for people, like, so there's the way this works is that you've got like a national regulation that you're putting in place, and in Europe, because it's a federated state, it's a European-wide regulation. But you want to be looking at the noises that are coming out of organisations such as FATF, FATF, the FSB, and IOSCO. IOSCO in particular, they regulate at a supranational level exchanges. So they would regulate the behaviours around the ASX, the London Stock Exchange, New York Stock Exchange, and also increasingly around digital assets. Now, they've got a consultation paper out that BTC Markets are going to be contributing in response to, and they're setting out a framework. But what IOSCO say, everybody has to follow in some regard. So we can create national policies and national decisions, but we have to feed that back up into what IOSCO say, what FATF say, and what do the FSB say. Because if you don't play by their rules, there's a whole other world of pain coming for you. So that's what has to happen. Right. So even though we're looking at it from a national level, there is a whole other body that needs to be engaged with. And we can be sure that the regulators here are, I know full well that they are. I know they're members of IOSCO, for example, the ASX. I know that ASIC would definitely be involved with conversations there. So I'm not suggesting by any stretch that they're not. But for us in the business, that's actually where we need to be keeping an eye, as well as what we're seeing coming out of ASIC.
Yeah, that's interesting. Lots of moving parts. Let's talk about tax then. So I want to cover a little bit about ATO guidance at the moment on crypto assets. And before we do, we're in 2023 now. End of financial year is approaching, and we haven't seen updated guidance from the ATO really since last year. And last year there was a small tweak to guidance on airdrops, and we can talk through a little bit about that. And so we're essentially running on what the web guidance says is the ATO's view of the tax treatment. Now, web guidance isn't law, so it's not legally binding. It's the ATO's interpretation of the law. And what's interesting with that is it does create some very confusing outcomes for when you are more involved in crypto and you're kind of taking part in these more advanced transactions. And so there can be some nuances that throw up. I would say that if you're in that bucket of using crypto for more than spot trading and these kind of very simple transactions where I said the tax treatment is probably a bit clearer, then definitely see an accountant that understands crypto, that's engaged in crypto space and knows what you're doing. So very important. So when we go into the tax rules, so you're an everyday investor wondering, what's my tax treat? Well, when do I have to think about tax for crypto? So first of all, you have to work out whether you're actually a business or an individual, right? And it's not as easy as you think. So a lot of people might say, I'm running a business, I've minted an NFT. Not always the case. It's not just based on how much crypto you trade, because one of the differences between, I suppose, more traditional asset classes like stocks, shares, and crypto is you can easily rack up high number of high volumes of trades on crypto exchanges in comparison to, say, if you're trading stocks or shares. And that's because you're going from coin into coin directly, not necessarily selling one, waiting for the funds to clear into your account and then purchasing another. And so that's kind of something to recognize is if you do send reports to your accountants, they may say, you've got thousands of transactions, you're definitely running a business. Not always the case. And so I mentioned earlier, but in general, if you're investing in crypto on the side, you've got an everyday job that's not related to crypto. You use crypto as an investment. And what I mean by that is you hope the value of it increases over time. Then you're likely to be treated or taxed under a capital gains regime, and we call that an investor.
Can I ask a question here? This makes me a bit silly. Yeah. How much is capital gains tax? What's the tax rate on that?
Good question. So capital gains tax in Australia is not a separate tax. So this does confuse a lot of people.
Okay, good.
So in other countries like the UK, there is a separate capital gains tax. So again, that's where maybe some confusion comes in. Some people, the capital gains tax in Australia really means income tax eventually, but you have to work out the amount of gains first. That's then subject to income tax at the end. So essentially all your gains at the end of the year on assets will then just get funneled back into your income tax summary at the end in your tax return.
Okay, so the profit I make gets reincorporated back in as income.
Yes.
and then taxed at whatever income rate I'm at.
Exactly. So we
Goodness,
tax your ordinary marginal income rate. So,
Okay.
And there's different bands depending on your income level. Capital, and we'll run through this, but if you are a on capital account, there are tax benefits such as 50% discount on capital gains if you hold for more than 12 months. And so then only half the gain will get funneled into your income.
Oh, cool.
So so that's the first step really is are you a business, are you not? If you think you're running a business, there's again not a clear line. So there's kind of factors that may lead to you running a business, such as, you know, the nature of your activities, whether you've got a business strategy in place and you're acting in a business-like manner. That's generally the type of terminology the ATO will use. And, you know, have you invested capital to run this operation and so on. So yeah, again, if you think you might be running a business, speak to an accountant to work through which one you are, because they're different tax rules if you're running a business.
Okay.
For the purpose of today, we'll focus on the kind of individual investors and capital gains. So very quickly, what is capital gains tax? It's the difference in the value between what you've bought your crypto at and what you sold it for. And so you need to understand a couple of things. One is your cost basis. So what's your purchase cost plus any associated fees? So if you've incurred fees to actually purchase crypto on exchanges or so on, you can include that into your purchase price, and that will be your cost basis. When you later go and sell your crypto, and we'll talk about when you sell, you need to work out the value of that disposal value to understand if you've made a gain or a loss.
And is there like FIFO or LIFO, or how do you calculate it? Because I mean, Bitcoin is Bitcoin. So which brushes do you use?
Yeah, it's a good question. So how do you actually work through what cost basis method to use? So all these terms, FIFO, HIFO, LIFO, they're different cost basis methods. So FIFO stands for first in, first out. So what that means is essentially, let's say you're buying and selling a load of Bitcoin during the tax year. You need to understand which portion of that Bitcoin to take in your gain or loss calculation. So first in, first out will actually take the first Bitcoin you've purchased as the cost basis, and it will kind of run as a kind of moving first in, first out calculation. So when you then go and sell your Bitcoin, it knows exactly where to take your purchase price from. And so last in like LIFO, last in, first out will be slightly different. It'll take the kind of price that you've more recently purchased the Bitcoin, if you like, as your cost basis. So you can set cost basis methods on softwares like Koinly as well. So, you know, again, speak to your accountant to work out what's best for you and best types of inventory methods that apply. But they do have an impact on your tax bill because obviously crypto prices are very volatile. So we default to first in, first out. But, you know, in Koinly settings, you can change that to apply the most appropriate.
And can I change that every year?
Yes, you can.
Yeah, because that's the thing. Because like some years that makes more sense to use FIFO, and then other years definitely LIFO.
Yeah, absolutely.
So,
yeah.
Right now you're not looking at FIFO. If you bought early, you're definitely looking at FIFO. That's interesting.
That's a really good point. So yeah, definitely check that when you are going through your end of year tax process, and speak to your accountants about, you know, which one is best for you, obviously within the ones that are applicable. But yeah, very good point. A couple of benefits with CGT. So if you've made long-term gains, I mentioned you're eligible for a 50% discount. If you've also made losses, so if you actually realize losses and sold, you can utilize those losses against current or future gains. And if you don't have any gains in the current year, you can carry them forward.
And those gains specifically within crypto transactions, or do they roll across all of your investments and your income, like your day job, or where does that start and end?
So you can roll them across other capital assets, but you can't kind of switch between capital and income.
Okay.
So what that means is you can't make a capital loss on your crypto and offset against your salary and wages.
Yeah, that's what's going to want.
And that's what a lot of people want to do. Yes. And the ATO have actually been very clear on those types of, you know, a lot of people say, oh, I'm running a business, so you know, I'm trading stock rules and so on. And it's really hard to kind of get into that. So, you know, capital assets are a separate regime. But you do get the benefit of loss harvesting, it's called, when you can carry those losses forward. And, you know, let's face it, a lot of people are probably in that position where they're holding crypto at losses, and, you know, they might be wondering, oh, I'm not going to worry about tax this year because I haven't made any money. but there are benefits to be had. And to realize those benefits, you need to work out what your capital losses actually were. So some people, another thing that people might be doing before 30 June is wondering, okay, well, I've got crypto in my portfolio that's not performed well. I might sell it before 30th of June, realize the loss, cut my losses, and then offset that against any gains you may have, a property that you've sold or so on. And so, speak to your accountant about that before 30th of June if that's something that you can benefit from. But again, you can carry those losses forward.
I think, if I may as well, as an exchange, one of the problems that we have in terms of, not that we're ever trying to provide tax advice, but one of the issues that we have when people come to us asking us about tax reporting and various different bits and bobs is that we can only see what happens in the BTC Markets ecosystem. We don't know where you've traded elsewhere, what that looks like, or how long you've been doing it for, and nor should we. It's your business, not ours. And I think one of the benefits then when it comes to tax time is using platforms like yourselves where you can get those feeds in, aggregate the data, give it to your accountant or whoever it is that's giving you the tax advice to work out things like LIFO, FIFO, all those kind of different nuances that, we would never be able to do, nor do we want to. We would never be able to do. And I think that to your point, as you're talking about it, I'm just thinking, God, yeah, somebody who's got, spread across a few different platforms, and if you've got stocks and if you've got company and or property, makes so much more sense to aggregate all that and just
absolutely. And your fees for your accountant are sort of tax deductible as well. So a lot of people are thinking, I don't want to spend the few $100s on using an accountant, but the benefit you might get will likely outweigh that. So
yeah, absolutely.
Something to consider. And you mentioned various platforms and kind of people having their tax events spread out across different exchanges or wallets and so on. So we typically see our users on average have around 3 to 5 integrations, different wallets, exchanges. There's a big trend to self-custody in crypto at the moment, and I think that's interesting because what we actually did see from users in Koinly was that people were connecting cold storage wallets more, and they were transferring their crypto from exchanges onto cold storage wallets. And as a result, needing to add their cold storage wallet into Koinly as a different integration so that Koinly can tie up everything at the end of the year for tax time. What's important as well, I'd mention, is to really get an ideal picture of what your tax outcome is. You need to either give Koinly or your accountant, if they're working it out, all your crypto transactions, not just in the year, but essentially since the beginning of time. Because you may have first purchased Bitcoin in 2011 and decided to sell it now and made a huge gain on it. But unless you can really tell the software or the accountants when you first purchased what the value was, you won't be able to get an accurate gain or loss. And if you're going through that in Koinly, we'll actually flag kind of errors if we don't know what your purchase history is.
That's cool.
So we'll try and marry up the cycle of when you've purchased and sold, and it will flag, hey, there's some missing purchase history here. So let's talk a little bit about when you actually pay capital gains tax. Again, I said if there are simple, when you're spot trading, the rules are fairly clear, simple guidance. So first one, and there's a few kind of nuanced things in here. So if you sell crypto or you gift it to someone, that's a taxable event. So if you're selling it into AUD, fiat currencies, if you're selling it, if you're sending it to someone, it's at that point which you lose control of your crypto is when you kind of have to work out, do I have a gain or a loss?
That's the shocking bit. If I give my niece for her birthday some Bitcoin, I've got to pay tax on it. If I give her Aussie dollar, no worries. But if I give her Bitcoin, I have to. That's the bit that kind of, we need clarity. We need clarity. The industry demands clarity.
Well, and you can look at it in different ways, in the sense that, let's say you originally purchased that Bitcoin for your niece, and what was your intention to holding it? Were you hoping it would go up in value? With AUD, you may have invested it, you may have just held it in a bank account, but it's seen as in a very separate way on the tax rules, because you may not have made that huge gain on the crypto that you've then given to your niece. And so the ATO want that portion of the gain at that point when you no longer have access to it. So
yeah, I guess it's quite a thing, because like if I've got Aussie dollar in the bank account right now, I'm making a little bit on interest on that, and I suppose they treat that interest separately. I do have to pay tax on that interest. Okay, that's a fair point. But when if I buy my niece Bitcoin to give to her pretty much straight away, like the purpose is to buy, the fact that there could even, I mean, they've been, well, mind you, the way crypto goes, goodness knows what kind of price point I could have made a loss on that thing. And
if you have made a loss, you can
then it's a great law, and we agree with it.
Exactly.
Anyway, sorry, carry on.
If you gift crypto to a registered charity, then you may be able to get some relief on that.
Okay.
So it's worth noting, but it has to be on the ATO's list to deduct that. The other one, and this is probably a bit more contentious one, if you trade or exchange crypto to crypto, that's always a taxable event. So, okay, if you're going from Bitcoin to ETH, and you then, we mentioned it earlier, you sell your Bitcoin, you purchase a new asset, ETH. But if you're wrapping crypto, so if you're going from ETH to wrapped ETH, the ATO do see that as a taxable event. Whether that should be a taxable event or not is up for debate, because if you're trading NFTs, you might bid for NFTs in WETH and eventually pay for that NFT in ETH. So you're really just using the wrapped ETH to save on gas, because ETH gas is expensive, and then you end up buying the asset in ETH. So that's an interesting one. Lots of debate there. Lots of debate has come up on that at the regulatory level as well, because it creates a lot of implications for DeFi. When you're providing liquidity, lots of taxing points occur at the moment. That's a general trend as well. The way the rules are structured, you basically have loads and loads of taxable events, and it's really hard to actually record what your tax summary is without the use of software now, because it'd just be so many Excel lines on transactions. The other point is, I've got on here, convert to fiat currency. We don't really need to cover that. That's obvious. The final one I do want to kind of just talk about a little bit is when you use crypto to obtain goods or services. So there is a bit of a misconception around here. And people think if they've got crypto that they use to spend on coffee or clothing or everyday items for personal use, that is not taxable. And so, and that's wrong. It definitely is taxable when you do spend. And the ATO will see that as a disposal. Now, there is a rule called the personal use asset rule, which is if you spend under $10,000 value on something for personal use, you can exempt that from capital gains. But the key there is it has to be an item purchased for personal use in the first place. So if you've held your crypto in your wallet for any significant length of time, the ATO will say, well, that wasn't an asset used for personal use. It's actually an investment. And all you're doing is you're selling your investment to pay for something.
Oh, okay. So it's how long that the crypto, or say the Bitcoin's been sitting in your wallet for.
Exactly. And so we don't have clear guidance on time frames. How long is too long? And we do need some guidance around this. But a lot of people think they can use the personal use asset rule. And it's actually, I think it's clearer now on the ATO's website that, generally it's personal use assets rule doesn't apply unless you're purchasing crypto to spend on something very quickly that is for personal use. So I guess an example could be if you're going to a concert and the concert gives you a discount for purchasing their ticket in crypto, and you're not a crypto person, but you want to get the discount. So you go, okay, well, I'll buy Bitcoin. I'll then, with the intention to then buy the ticket, not straight away buy the ticket. And that would be a personal use asset. You're not going to make a big gain or loss in that time. Maybe you will. Who knows? Volatile markets. But that's the general principle of...
it really isn't clear, is it?
It's not. And just to throw one other spanner in the works there, spending cards are becoming a big thing. So, crypto credit or debit cards linked to your balances, or I've seen credit type cards as well, which offer cash back in crypto as well. All sorts of tax nightmares there. Again, if you're using that card, it's not like you're using your bank balance to buy your personal goods. It's you have to really understand what your taxable events are.
That's interesting, because we've actually got an AFSL license under our sister company. That means we could do that we can issue that financial product. We haven't done it yet because we were doing other things. We've been busy, but that's interesting. I didn't realize then that every time somebody would use that stored value card or whatever it is, that they would be taxable.
That's right. And so is that something people are asking for? I've seen an increase in just these products available, and people asking, through Koinly support, how do I deal with these, or how do I plug these in? But are you seeing people really want these types of cards in the space?
I think there's an interest in it simply because I think the people who are in crypto really like things that are novel and want to push boundaries on the possibilities. And I would consider myself one of that. And I think our team is like that too. But particularly when we were in the bull, there was probably more of a clamor for it. But now that we're not, although we, who knows where we're going to go in the next year or so, that hasn't been. People have been more concerned about other things during this period of time, from looking at the feedback that we've received at the exchange anyway.
Yeah, right. No, very interesting. So next one up is, so this is where things might maybe get a little more complex. So you can also pay. So I mentioned earlier that capital gains tax isn't a separate tax, but it's kind of this concept that applies to crypto or other capital assets like investment properties, shares, and and so on. So you can also have transactions that incur income tax consequences straight away, so outside of capital gains. And so, and you kind of mentioned it earlier, when interest from bank accounts, you kind of thought, oh, well, that would be taxable. So interest like earnings on crypto are generally going to be taxable as ordinary income at market value when it's received.
Okay.
And so what that means is you don't have a gain or a loss or consider capital gains, but you have to then include that crypto that you've received as income at the AUD value.
Is this airdrops?
So we'll come on to airdrops. Airdrops
okay.
It can apply to airdrops.
Okay.
That's the answer. And I'll explain why I'm being a bit vague there in a minute. But staking is the prime example. So if you're staking crypto and you're earning staking rewards, those rewards are taxed as income, ordinary income at market value when you receive the rewards. And so really, there's all sorts of, that's what the web guidance says. That's the generally accepted principle around staking as well. I suppose you could think of it like shares. When you get dividends, it's taxed as, it's taxed at the point you receive the dividend. You have to include that, but you get these nice summaries when you invest in the shares generally, which say what box to put the dividend income in and so on. So with crypto, you don't really get that. So you're on your own unless you use software effectively, or you're really kind of tracking on a spreadsheet when you received your rewards and so on. So staking rewards is the common one. It's ordinary income when you receive the tokens. There was a bit of debate around, what does it mean when it's received? And that's still a bit of a gray area because, in some cases you can receive staking rewards but not actually access them yet or spend them or sell them. So is it that at that point? And I think the general approach has been, when you actually obtain control of it is when you can. So for example, ETH staking rewards, when they were unlocked recently, that was when the staking rewards be taxed as income. Now, of course, the timing is very important because ETH price fluctuated a lot during the period at which staking rewards may have accrued to when it was unlocked eventually. And so, very different outcomes for tax if you take different points in time. So it's very important you understand when and what when received means essentially. And so, again, if you're not sure, speak to accountants to navigate that because it is important. It can lead to a lot of dollars for tax purposes. Airdrops, we'll talk about airdrops. So you're right, airdrops would be taxed as income at market value. You'd pay income tax on it. Now, in September last year, the ATO changed their rule on it. So the rule previously to the change was just like staking, airdrops are taxed as income. But a lot of people were saying, well, hang on, because airdrops are generally used as a marketing tool. So if people received airdrops in a wallet because they interacted with a certain protocol in 2013 and they've just got the airdrop, why should they then have to pay tax on something they haven't asked for? It's a very crypto specific concept, airdrops. You don't really get anything like it.
All I can think of is U2 dropping the album into everybody's Apple player thingy. Can't remember what it's called back in the day, and everyone was absolutely outraged. How very dare they?
Yeah,
and we didn't pay tax on that either.
Right, okay. I didn't think of that one.
Probably I'm Irish, that's probably where that one comes from.
So before it was always taxable when you receive it, but a lot of people were kind of saying, well, is that the right tax treatment? If I airdrop something to you, like if I airdropped you $1 million, you're going to be taxed at $1 million. Well, yes, but I also have a disposal event when I send it to you. So all these types of debates coming on. Now the ATO have introduced this term called initial allocation airdrop. So essentially, if it's the first of its kind, and I've got a slide on this here, which I'll just pull up. So if it's the first of its kind, and you essentially have received your airdrop as a promotion or a one-off marketing event, then that won't be taxed as income.
Okay.
But you do then later have to declare it for capital gains when you sell it.
So what would you put down as your opening price on your tax form if it's an airdrop?
So
Zero.
Okay. Yeah. So your cost base is zero, which means any gain that you apply will be taxable, unless you've held it for a year.
Okay.
You'll save 50%. So that's an important one. It's also important to understand, again, when you've received the airdrop, when you can actually sell out, and there's all these complex and nuances to it with liquidity issues that might come on certain airdrops, with you being unable to sell potentially, and so on. And so that's when it does get complicated. It's a very grey area. So seek advice if that's you. But we have had some airdrops that then come in two phases. So if you get a subsequent airdrop of the same token, the same project or company, that will then not be an initial allocation airdrop, and so you'll be taxed at ordinary income at that point. So that's the current rules. This initial allocation concept is fairly unique to Australia, which is interesting. And then a couple of other examples on income tax is just any type of earn activity. So we're seeing step to earn type things out there, and DeFi, if you're borrowing and lending, you're earning yield or interest, generally the yield will be taxable as income. So definitely make sure you're up to speed with all that. It's also crypto is not a good place to hide when it comes to this stuff. So if that's what the ATO have said, it's really up to you to come up with the evidence that you've got, to support your tax return at the end of the year. So that's airdrops, we covered that. And then just finally, like super as well. So more and more people are holding crypto in super.
Absolutely.
It's interesting because the ATO actually published stats on the breakdown of asset classes in super in kind of various different points in time. And so March last year, super for crypto investments reached over 200 million, which is, okay, it's probably it's a very small percentage of total assets, but that trend, or the asset class crypto, has been the highest increasing asset class in super over the last few months or years. So more and more people are wanting to use crypto and super. I would say first and foremost, if you do that, be very, very careful, because superannuation rules and regulations are very strict. So there's very strict auditing requirements around it. You have to, for example, legally show the assets are separate to your name. They have to be, they essentially have to be for the sole purpose of your retirement benefits, which is generally what super is. So you can't have easy access to it. It can't really be merged with your everyday investment accounts. It has to be separate. And there's really a strict process you're going to have to go through to actually be disciplined to separate the assets, so that you can't easily buy and sell access for your personal use, for example. It has to be in a separate super account. It has to be audited. You have to get your auditor comfortable that you're complying with all the various requirements. Is it in your super's investment strategy to even do that?
That's the piece that we look at when people are opening up SMSF accounts, is specifically that, like, are you actually able to do it under the mandate of your SMSF, which is somebody who, all this is so foreign to me. So this is a real learning to kind of the years I spent in Australia to get up to speed around the SMSF culture and what it all means.
And can people then use BTC markets?
Oh yeah, absolutely. We've got a huge. What we've found the evolution has been is that generally the young man will open the account, then his wife or partner will also follow. Then a couple of months later, the next step then from that will be that they will invariably open maybe a company account. Right. If it's a small business owner, they open a company account. Then we see the next step up being they get the SMSF linked in, and that has been the general trajectory.
And you can actually see that.
Yeah, we see it. We see it all the way up as people get more comfortable with what they're doing in crypto. And I think that's probably both when you're dealing with taxation or if you're dealing with investment of any kind. That staggered approach as you get more comfortable with what you're doing is sensible. But that seems to be the way that Australians have done it. So I think that this idea that Australians are going gung-ho and it's the Wild West, this Lincoln Wild West analogy, really doesn't mirror what we're seeing Australians do on our exchange. It's only Australians that are on there. So we can look at their behavior and go, well, this is what they're doing. And it's really not like that. They seem to be quite almost conservative in how they're approaching it, and they've been quite sensible. So that kind of headline grabbing behavior just doesn't really reflect reality in our experience anyway.
Yeah, interesting. So if you are one of those people that have set up a crypto account and you are looking to invest a little bit of your super into crypto as well, beware, there are strict rules, auditing requirements. You have to meet the sole purpose test. You have to understand if it's in your strategy of your self-managed super to do in the first place. So definitely don't just jump into it without understanding the facts. I think it's important.
Yeah, absolutely.
So let's talk a little bit about lost crypto. We are running a little bit out of time, so I'll cover this quickly. But if you do lose your crypto and you've actually lost it, so it's not that the exchange may have gone bankrupt and they're going through Chapter 11 processes and you may get some of your crypto back or not. At that point, it's still uncertain. So you have to really understand. You have to be able to demonstrate if you lost it, it has been stolen. And, on the screen, we've got some types of evidence that you can present to the ATO to prove your ownership, essentially. So dates you acquired crypto, when you lost your private keys, digital wallet addresses, costs to acquire, some type of evidence that the wallet was in your control. But the key thing there is, and in that case, you can claim capital losses.
Oh.
So there is some relief perhaps if you've had your crypto genuinely lost or stolen, but not if the return of your crypto is uncertain through bankruptcy or so on. So that's an important point there, because lots of people, particularly this tax year, November with FTX, lots of people wondering, what do I do? And it's really not good news for taxpayers because there is that uncertainty around it. Yeah. So just some other things to watch out. We covered most of these, but I will talk. So I talked a little bit about capital losses before. Now I also talked a little bit about, we're coming up to 30th June. Some people may consider loss harvesting strategies to actually sell before 30th June to then realize or utilize any losses. There is something called the wash sale rule that we need to talk about. So that is, we're 30th of June, you're holding Bitcoin at a loss. So, sorry, we're not 30th of June, we're 14th of June. You're holding Bitcoin at a loss and you think, okay, well, I want to get some benefits from these losses. I'll sell it now, but really I still want to hold Bitcoin. So what you then go and do is you go and repurchase that Bitcoin on the 2nd of July.
Got it.
And you never really had an intention of getting rid of the Bitcoin, but you wanted to claim the losses. Now that's called a wash sale, and there's a wash sale rule in place where the ATO can come and say, well, hang on a minute, the actual substance of that transaction was you just wanted to save a bit of tax, but you never really intended to dispose of your Bitcoin. And so that wash sale rule can basically deny that loss. So be very careful. The ATO have actually come out and said that specifically around crypto.
They're looking at it.
They will look at people that wash sell or wash trade.
Or look for it,
Yeah. And this isn't, for anyone listening, this isn't a specific ATO or Australia kind of nasty tax rule. This is or a crypto specific tax rule. This is a general tax principle that's been around for many years across many different countries. It applies to equities or other assets where you might be able to buy in and out quickly. So just be aware of that. I mentioned personal use assets, so we won't cover it again. Splits and forks, so Bitcoin and Bitcoin Cash, ETH Classic. If you receive new tokens from a fork, you don't have income tax when you receive them, but the cost base will be zero.
Okay.
We talked about wrapping and liquidity. If you're providing liquidity, you may have disposal events. So just some tips then quickly. So definitely keep good wallet hygiene. So we mentioned SMSFs, that is an extreme example where you need good wallet hygiene. But just be able to have a clear track of where your assets are and on which platforms or which wallets. It makes it easier when you actually go into tax time. There's a CGT discount if you hold for a year or more, so we covered that. Record keeping, so use software to keep a record of fees and trading expenses and so on, and losses. I mentioned you can donate as well, and you may get deductions if you donate to a registered entity or charity.
Yeah, cool.
Loss harvesting is another tip. We've covered that. And yeah, again, just use an accountant if you're unsure on this stuff. It's really important to get proper advice on this. So that's pretty much it from the presentation. I've got a slide here on record keeping, but I think we covered most of it. So let's jump into some Q&A because I know we're trying to get through this as quickly as possible, and there's been a bunch of questions that have come through. So one question that's actually come for you, Caroline, is how does BTC Markets differ from other exchanges, and why would a customer want to use them over others?
That's a really good question. So I think the focus for us has always been on Australian clients, and I think that's probably one of the key differentiators. We're also a really conservative organization in a very risk-on environment, and so we don't tend to take follow the latest trend. We tend to be like, well, okay, quite conservative in our approach and what we do. The reason why that's beneficial,
so no Pepe.
No, but it's not because we're casting aspersions or turning our nose up at it. It's not like that. It's just instead the framework that we work to, like I said at the top, is really around supporting that blockchain economy. If you're making money on Pepe and all the other meme coins, go for your life. I think that's brilliant. Have a chat with the ATO, but you're doing a really good for you. But that's not what BTC Markets are about. I suppose, as I say, where we differ is the fact that we've got such an Australian focus. We think about our clients constantly in that framework. Or like, okay, well, what do Australians want and be a part of? We had the partnership with Vault Bank, which is actually where we got the FSL in the first place, specifically because we wanted to bring banking and crypto together. They're an Australian bank, always going well with them, and unfortunately, COVID dried up funding, and unfortunately, they couldn't survive past that. But we'd worked so closely with them to try and bring that kind of traditional finance and crypto to the Aussie audience. So our focus isn't on what's happening in Singapore and New York and all these other different places. It's not that we don't care or that we're not keeping, kind of the latest on the news. That's not where our clients sit. They sit here. So I suppose that differentiates us in some respects, and the fact that we are, I suppose, I refer to us with the team, I refer to us as the designated driver of Australian crypto, meaning that we're going in the direction that you're traveling into, except we're sober behind the wheel. And that's probably the best description I can give of BTC Markets. That's us.
And so just to kind of pick into that a little bit, so you mentioned AFSLs. So do crypto exchanges need AFSLs at the moment?
Right. No, to trade spot, which is what we do, we don't. The AFSL that we got under our sister company, BTCM Payments, was specifically around that partnership with Vault Bank and specifically around non-cash payments, which includes digital payments and so on, which is likely to be something that we'll explore in the time to come. And also we're partnered with MasterCard, and their tech suite is amazing around digital payments. So there's things there to be worked at and looked at. But to trade spot, you don't. Anything involving derivatives, you need a financial license. So earn, stake and flow, you need a financial license to have a look at that.
And we've seen some implications of that recently.
When you don't have one, yeah.
So that's a really good summary. Thanks, Caroline. Another question we have is the Koinly question. So does Koinly take into account the 12-month holding rule for 50%? So I'm assuming So I'm assuming this is relating to the 50% discount we talked to. So yes, Koinly does. Koinly will recognize if you've held that parcel of crypto for less than 12 months, and
Okay.
also it will categorize it as a short-term gain and a long-term gain. Where you'll see that is actually in your tax report page. So when you've actually gone, so the way it works, you plug in all your wallets, exchanges, BTC markets, everything goes in. You can then see all your transactions. Make sure you give everything to Koinly. I said that before, it's really important to get the full picture of what your gain or losses are this tax year. And you can then download various different tax reports. So we're focused today on individuals and CGT, but you can also download trading stock reports if you are a business. If you download the individual one, there's 2 reports. You can do a complete ATO report, we call it, where you essentially have all your income summaries. If you've been staking, your capital gains summaries, and we'll split out there your short and long term. And talking about tax reports, probably a good time as well to mention the discount offer that we have. So we have 30% off your next Koinly crypto tax report, and the code is BTC Markets 30, and I think we'll put that in the link somewhere so people can see it. So definitely get in on that if you haven't got your tax report yet. Let's see, do we have time for one more question?
Actually, can I just ask a question? What's your basic package start at then? What's the basic price point for Koinly?
Oh, that's a good question.
Because am I thinking about hundreds of thousands of dollars? Like, what are we dealing with here?
So if you are a basic crypto trader and you have, let's say, under 100 transactions, I believe it starts at around $60.
Oh my God.
So
that's so good.
It's cheaper than an accountant. Obviously, you can use Koinly with your accountant. And that's actually a good way to cover up another question, which is, can I use Koinly with my accountant and how? So essentially, the software isn't a replacement for an accountant.
Okay.
And it's like any software, you know, if you put garbage in, you'll get garbage out. So you have to provide all your transactions from the beginning of time to work out your tax position this year. But of course, there are different tax settings that apply. And so you need to make sure those tax settings are correct for you. You know, for example, are you recognizing income at the right points? Are you using HIFO, LIFO, FIFO? Which one are you using? Which is best for you? And so on. And so in that case, your accountant can be shared access to Koinly through a separate platform that they can have access to. We call it the accountant's platform. And if you share access with them and they have a Koinly account, they can see your transactions, download the reports for you. It is actually the easiest way to manage the kind of tax process and use Koinly, because then your accountant can do everything for you. You'll still need to integrate all your exchanges and wallets. So yeah, that's just an important thing to consider over there.
Really good.
Okay, I think we're probably running over time. Let's see if we can do one more.
So many questions about taxation. Who would have thought it? Oh my goodness. Are we going to be able to respond to these questions after the potty?
So we can. And again, you know, if you do have specific questions, you can reach us at koinly.io, and there's blogs and guides and you know, there's a lot of information, education obviously out there. It's not tax advice, just like this webinar.
This is not tax advice.
So what should I do if I've received an ATO letter? Is one of the questions. So, okay, so if you have received, and is this one that asking for a friend maybe? So if this is the case, you know, the first thing to do is actually to take action and not just sit on the letter and ignore it. So the ATO said, look, and something we haven't covered that actually I will just say now is the ATO will know you have crypto, even if even before you've done your tax return, and they'll know that through a few different methods. So exchanges have data matching programs with the ATO, bank feeds as well, where banks will send information to the ATO and so on, similar to AusTrack for money laundering, compliance, etc. And so, really, really important that you understand the ATO will have a picture on what your crypto matters are before you even submit your tax return. So when you do so, they may marry up the balances you've reported and what they can see on their end. We don't know the ins and outs on what exactly they have, and I don't think they'll give their full cards away at the moment. But something to be aware of. So it's obviously not a good place to hide. But if you have received a letter, take action, see an accountant so they can help manage that process with the ATO. You know, have you missed returns previously? Maybe you haven't, and you've just missed your crypto balances. Maybe you're too overwhelmed to kind of report your crypto or didn't really have an idea as to where to start. So hopefully this is a good overview of kind of where you can start and the tools and resources out there. So yeah, take action, don't delay, and
Good luck.
Yeah, good luck. Let's see. Let's do a couple more. Does Koinly work with NFTs and DeFi? Yes, that's the short answer. What is Koinly currently working on? Okay, this one's interesting. So I mentioned we cover a lot of different jurisdictions and countries and the tax rules in various places, and you know we stay on top of them actively. So you know we'll know when guidance comes out. We often do kind of lobby on policy side as well on behalf of accountants and our users to really kind of get tax regulation that makes sense. It's not odd when you know kind of end up with thousands of transactions where all you've been doing is buying and selling Bitcoin and Ether and so on, or staking or DeFi and so on. So it's just so we are on top of the rules. We understand them. We take part in consultations with Board of Tax in Australia, for example, but also in the UK with HMRC. They've recently got some guidance out there on staking and lending in the DeFi space. And so we participated in consultations around that. And they're proposing some really interesting rules which should soften the compliance burden or the taxable kind of events on staking and lending in some cases. So that's interesting. Maybe one for another session though. So we're also working on building integrations. So one of the things we do well is build a vast array of connections or integrations with various different platforms, exchanges such as BTC Markets. And so there's a couple of interesting ones we're working on at the moment, different chains. We're going to have some major DeFi improvements on the software. So that should be interesting. That will come ahead of the Aussie tax season as well.
Awesome.
So stay tuned if you are into DeFi and have no idea where to
and
start.
And who isn't?
So if that's you, then yep, you'll hopefully like some of our products. Again, as well, I'll mention, do give us feedback as well. We're always keen to hear from our customers and users, you know, how have you found using Koinly? So if you are using Koinly, if you used it last year, reach out to us. We have a great support team. And I'm sure the same goes for BTC Markets as well.
Absolutely.
So the other thing is follow us on Twitter at Koinly if you want to be kept up to date with integrations. I think we've activated Siri over here. If we've found you know, new announcements or integrations, it'll be on our Twitter, awesome. Or you can reach out to us. I think we better wrap up there. We will kind of follow up on the questions that are asked at the end and post that, and we'll post the offer code as well. But thanks very much, Caroline, and yeah, thanks for talking tax for an hour. I know it's not the easiest subject, but I think we've got through it. Exactly.
No, thanks so much. It's been brilliant. Yeah, I've learned a lot. Really good fun. Thank you very much.
Thanks very much. All right, great.